Welcome back. We are now in segment 8.8. In this segment, we are going to discuss about the importance of the level of cash and bank balance projected in the CMA data. If you remember, actually, we discussed this point in an earlier segment, right? While discussing about item-wise item on the balance sheet, when we encountered that current assets under current assets, when we encountered cash and bank balance projected, I think this is a point which we already covered, but it is worth repeating, right? Because of its importance. So again, I'm going to explain this point. So when companies submit the CMA data for enhancement, right, or renewal, right? So there is one item you should always watch out for. That is cash and bank balance projected. Right? If you recall the CMA data, liabilities, assets. Okay, they'll be submitting CMA data for the next 2 years. Okay, so say for example we are in 2013. For the next 2 years, 2014-15, will be submitting CMA data if it's for working capital renewal or enhancement. Okay, next 2 years. So liabilities and assets. So under assets you have current assets, fixed assets, non-current assets, intangible assets. Okay, so under current assets there is an item called cash and bank balance projected. So you should always see that this item, the cash and bank balance, should not be very high, right? Too high, it is not something which is encouraged, right? Because you should understand the logic here, right? Say for example a company is having a CC limit of 250 lakhs. Okay, 250 lakhs is the existing CC limit. The company has applied for enhancement to 350 lakhs and submitted the CMA data projections. Okay, so now while going through the CMA data, you observe that the projected cash balance is 50 lakhs. Right? Now you should immediately question this, right? So don't worry about the numbers. Okay, just think from a practical aspect, right? On what the company is saying is 31/3/2013. This is the actual figure. Okay, so 12, 11, these are actual figures. Now the company is saying as on 31/3. Now the company is giving some projections for 13 and 14. So in this projections, he is projecting cash and bank balance as 50, right? So if you really, this is something in the future. Okay, we are right now in 31/3/2013. This is completed. We have the audited figures. This is for the next year. This is in the future. We don't know. But if you go to this particular point of to this particular date, 31/3/2014. If you imagine, if you are really in this period, if you really are present on this date, if you are a company, you won't be allowing this sort of situation. As a company, as the owner of the company, you won't be encouraging this sort of situation. So right, if your CC limit, see, as a company you will be having a CC limit. Okay, bank will sanction a CC limit, you will be drawing from this. So the CC limit is on the date, let us assume the bank has sanctioned the enhancement, is going to be 350. So your CC is 350. You have fully drawn the CC limit, you are paying some interest, say 15%. This is fully drawn. On the other hand, you have a current account, right? Current account is not a loan, right? This is not an overdraft limit, it's a running account. Okay, so here you have some. What you are saying is, on this date, by these projections, what you are saying is, on that date, as on this 31/3/2014, the CC limit is fully drawn 350 lakhs, right? The bank balance, right? The cash and bank balance is going to be 50 lakhs. Let us assume there is no cash on hand. The bank balance in the current account you have 50 lakhs. Now this is a very stupid situation. As an owner, this is a very stupid situation. You never allow a company to be having this sort of situation. On one hand, you are having a CC limit fully drawn up to 350 lakhs and you're paying 15% interest. On the other hand, you have idle cash 50 lakhs. Current account is not going to pay you anything, right? If you think you are the owner of this company, why would you be fully drawing CC limit 350 lakhs, right, and paying 15%? On the other hand, while you have surplus cash, idle cash 50 lakhs lying in your current account, right? And this is not paying you anything. This is not deposit account, current account. This is zero interest account. Right? This is not paying you anything. So when you have surplus funds, as an owner, what is your first intent? What is your first reflex? You transfer 50 lakhs to this CC account, bring down the liability to 300 lakhs, because you'll be saving on the interest. This 15% on the 50 lakhs which you have brought down is an interest saving to you, right? Bring this down to zero, or if you want to maintain a minimum 1 to 2 lakhs. Okay, you transfer the balance to CC account, bring down the outstanding and save on the interest cost. This is what you'll be doing as a owner. So if that is the case, you might as well sanction only 300 lakhs, right? If really the company is confident that is going to have a cash balance of 50 lakhs on that day, instead of sanctioning 350, just sanction 300. Okay, right? You might save the company if you're going to have, if really you believe in these projections. If the projections which you have given to submit to the bank are, really believe in those projections, if you really believe 50 lakhs idle cash is going to be there on that day, why not? Why do you want 50 lakhs? We'll sanction only 300 lakhs. Okay, that is what you can say. Okay, the company might respond by saying, see, we are going to we are going to have a lot of profit. We are going to generate very much surplus, and that's why our cash balance is high. They'll always try to furnish this sort of a justification, but that is not acceptable, right? Because that is the whole point. If you really believe your projections, if you really believe that you're going to generate so much profit and and going to have so much surplus idle cash in the current account, so why do you want to have a CC limit sanction that much higher? Why do you want such a high CC limit? Okay, so whenever you're pursuing your CMA projections, just ensure that the cash and bank balance is not at a very high figure. Proportionate to the CC limit, it should not be very high, right? So maybe 5 to 10% of the CC limit cash balance is okay, reasonable. You might accept, but don't if you're having a CC limit, projected CC limit of 5 crores, you can't have a cash balance of 1 crore or 2 crore. So high, that cannot be accepted. Okay. Oh, there are no rules. What is this percentage? There are no rules, but I mean, you use a judgment. Okay, you use a judgment. It should not be very large compared to the CC limit, right? So with this, we come to the end of the segment. The next segment we'll be discussing about drawing power. Right? See you then.